Good day. This is Market Wisdom for Traders, episode 27, delivered by Epi27 for forests, crypto, derivatives, options, equity, futures, commodities, and all chart-related trading. You can contact us for training. You can contact us for account management. You can contact us on 080 375 97085. As volatility increased, the number of contracts we trade dropped precipitously. Reducing exposure after losses will mitigate the chances of a catastrophic loss, but it will do so at the cost of adversely impacting performance. Overtrading and listening to tips are the worst mistakes the public makes in markets. Look where others don't. Adjust position sizes to overall risks to target a particular volatility. Pay careful attention to transaction costs. The popular Shakespearean monkey argument, that is, if you have enough monkeys randomly striking keyboard keys, one of them will eventually type Hamlet. It is possible to beat the market. The large group of economists who insist otherwise are choosing to believe theory over evidence. Winning from casinos presents practical problems. Winning players get noticed, and casinos have low tolerance for players who win by any other means other than pure chance. I taught myself in my own way. I was always an out of the box thinker. Don't bet more than you are comfortable with. Just take your time until you are ready. Proportional overbetting is more harmful than underbetting. In trading, the probability of winning is always an estimate, and often a very rough one. There are no zero-risk trades. We found that stocks that were most up tended to underperform the market in the next period, while the stocks that were most down tended to outperform the market. That finding led to a strategy of buying diversified portfolio of the most down stocks and selling a diversified portfolio of the most up stock. Buy low and sell high. When searching for new hedge funds to invest in, I screened out funds that I had an analyzed standard deviation greater than 15% or had an analyzed return less than 12% or had a bad year. We had a risk management process. If we lost 5%, we would shrink our positions. If we lost another few percent, we would shrink our position more. The program would therefore gradually shut itself down as we got deeper in the hole, and then it had to earn its way out. We would wait for a threshold point between 5% and 10% drawdown before beginning to reduce our positions. And then we would incrementally reduce our position with each additional 1% drawdown At 20%, our position is reduced to 0. Our maximum drawdown was about 40% to 50%, by which point we were trading only about 1/3 of our normal base position size. This brings us to the end of episode 27. Join us next week for our subsequent broadcasts. Remember to subscribe, share, comment, and ask questions. Contact us for training and account management on 080-375-97085. Thank you.